Have you ever wondered why accounting follows certain rules in the first place? Why do accountants record things the way they do, and who decides what makes financial reporting correct? That deeper thinking is what accounting theory is all about. Accounting theory is the set of assumptions, principles, and ideas that explain how financial reporting should work. In simple terms, it's the reasoning behind the rules of accounting. Think of it as the blueprint behind financial reporting. Accounting standards tell accountants what to do, but accounting theory explains why those methods exist and why they matter. For example, why should revenue only be recognized when it's earned? Why should expenses be matched to the same period as income? These ideas come from accounting theory. Now, accounting theory developed over time because businesses, investors, and governments needed financial information to be more reliable and consistent. As economies became more complex, accountants needed structured principles to guide financial reporting and reduce confusion. This led to concepts like consistency, prudence, materiality, and the matching principle, all rooted in accounting theory. So, why is this important? Because financial statements influence massive decisions. Investors decide where to invest, banks decide who gets loans, and businesses make strategic plans based on accounting reports. Without strong theory behind the system, financial reporting could become inconsistent or misleading. Now, accounting theory also helps shape accounting standards like IFRS and GAAP. When regulators create new rules, they often rely on accounting theory to justify why certain treatments make sense. Let's look at a simple example. Imagine a company receives cash today for a service it won't provide until next month. Accounting theory supports the idea that the company should not recognize that money as revenue immediately because it hasn't actually earned it yet. That theoretical principle helps create fair reporting. A common misunderstanding is thinking accounting theory is only academic and has no real world use. In reality, it directly influences how companies report profits, assets, and liabilities every single day. Another misconception is that accounting theory is fixed forever. It evolves over time as business, technology, and global markets change. So, what's the key takeaway? Accounting theory is the foundation of financial reporting. It provides the logic and principles behind accounting rules and helps ensure financial information is accurate, consistent, and useful. And once you understand accounting theory, you realize accounting isn't just about numbers, it's about the ideas that decide what those numbers truly mean.